Okay, hey guys, welcome to day 2 of the 4-day challenge for SPX 70TE. As you can hear, there's a lot of background noise. I really apologize for this. I did not know this was going to happen, and I hope they're able to get what they need done so that we can avoid the noise. But anyway, we'll get through it. All right, so let's cover what we covered yesterday in the agenda. We covered the expectations for the challenge. We went through trader psychology. We did a breakdown of the 70TE. What is it? And we'll get more into that now that we're going to add a trade today. We went through the trade plan, and as part of that, we reviewed the entry, exit, and adjustment criteria. Okay, and so with that, I don't know if you all had, if you read over the slides or reviewed the replay, but are there any questions before we start the session today? Anything that you have something that you want to learn or want to know? Okay. DXY, TNX up along with SPX. Okay. Yep. That happens actually. Looking at the dollar is actually flat, and it's trended down a little bit, but the 10-year note is going to be going up just because the Fed has announced that they are going to be tapering. So, and they're not going to be raising interest rates, but they're going to be reducing the amount of bond buying that they're doing from, I don't know, 80 billion a day to something less than that. So there's a top that the 10-year will go, but we really don't know. Some people think it's going to go to 2%. Right now it's 1.5%, but we'll see. Let me see here. Question: did you not use stations for? No, I don't use. Okay, so Robert asked, did you say not to use AM expirations for 70TE? Yes, you don't use AM expirations. Jeremy, what percent of my account should I trade on 70TE? That's a good question. It really should not be more than 60% of your account, and the way that I break that down is if you base it on a $10,000 account, you would trade one contract for 70TE on 3 expirations. That means 3 contracts. One for monthly and 1 contract for 0DTE if you trade 0DTE. So if you don't trade one or the other, right? If you only trade 70TE, then you can go up, probably use 2 contracts for every expiration, but you don't want to use more than 60% of your account. And this is a good question to give you a perspective. Okay. One of the bad things about credit spreads is that because you're basically utilizing a very small amount of the amount that it could go against you, right? The margin amount. There are going to be drawdowns to your account, and that's why you never want to go above 60%. Okay, and sometimes those drawdowns can be a little scary, right? And so in my account, just yesterday, right, and I trade in a $60,000 account for my trade service. So I traded. I was basically fully capitalized for my trading. So I had three 70TE trades, and I have multiple monthly trades on over around six positions. And so the drawdown yesterday in my account was about $4,000. I was in the red for about $4,000 just yesterday. Okay, and today, based on the market direction, I'm pretty much back to even, back to flat. So I just wanted to give you that perspective and that understanding, so you're not blown away when you're starting to trade these, that you see big drawdowns in your account. Okay. Sorry about the background noise, guys. You know, hopefully they go to lunch. Maybe I'll ask my wife to bribe them to see if we can see if they can go early. Okay. All right. Okay, so no more questions. So I'm going to start with a couple of questions on my own to see how you guys did overnight. And let's see here. Okay, all right, let's try this one here. Okay, this was in the trade plan, all right? So I'm putting up a question here. When should you adjust the trade based on expiration? Okay, not necessarily the positions, but expiration. Okay. All right. We'll give you a minute to answer that. Okay. Okay. So this is kind of I think I might have messed up the answer. I think it's you know, the actual in what the trade plan says, it's before the trade reaches 1 DTE, but that's also 2 DTE or before. Okay. So if you answered A or C, you were correct. And that's really the answer. Okay. So I kind of tricked myself. All right. Let me take a look here. Got 50% answered. Okay, guys. So I'm gonna ask another question. I'm gonna close this one. Thanks for your participation. Okay, let's try another question here. Did you guys answer when should you roll a threatened trade? I think we did that one yesterday, right? I think we did that. Okay. We did the delta on the put spreads. Okay, this is one that we talked about yesterday. So this one may be a little difficult, but let's see if you can get this one, all right? So what is the max loss of this trade? So we're doing 6 contracts, right? A vertical spread, 6 October, 42.10, 42.20. So what's the max loss on this particular trade? Awesome, awesome, awesome. Okay, you guys are getting it. Good. That's good. Okay, very good. All right, so the answer. Okay, I'll let everyone answer before we give it away here. Okay. All right. Okay, we got 50%. So I'm going to close the poll here. Okay, and the answer is right. So the answer is 5,500. All right, because what you're doing is you are subtracting the amount of credit that you receive. So when you put on a 7 DTE, the credit received is included, right? So you received that credit when you put on the trade. And so if you had a max loss on this trade, you would keep that 75 cents, right? And in this case, it's $75 times 6 contracts, right? So you would keep that amount, and then the rest would be part of the max loss, right? So the correct answer is $5,500, which most of you got. But 6,000, no, you know, understanding that it's $6,000, okay, is good, because you know what's important is that you understand what the max loss is. All right. Okay. Very good. Excellent. All right. So let's move on here. We're going to be covering now. Today we're going to be covering entering the trade. So we are going to enter the trade. All right. And it's really, today is not on the best conditions. because when the market opened this morning, I looked at where the market was going, and today in the morning would have been the ideal time to place the trade, all right? But I didn't place the trade this morning, but I'm going to be placing it today, all right, with you guys, and I'm going to show you basically, what we missed out on, okay? But it's okay because, trading 70 TE, all right, is not a perfect science, all right, and you're going to be placing trades in ideal and non-ideal times, all right, as a trader. And then the biggest skill that you can have in trading this is basically understanding and knowing when to adjust the trade. Okay, that's the most important thing, right? And if you have those skills, then you can conquer anything, right? You can conquer anything. All right. Okay. So we're going to put on the trade, and then we're going to talk about ideal and non-ideal conditions, when not to place a trade, technical analysis, common chart patterns, and indicators in trading, and how to apply them. All right. So that's what we're going to be doing. Okay. All right. So now I'm going to switch my screen here. Actually, I'm going to cover something before we actually go into the trade that you guys should know. Okay, so let's go through this, all right, because this is really important. All right, so let's talk about the credit spread risk and reward. Okay, we walked through this yesterday. Okay, so not yesterday. We talked about this. All right, so this particular position is what we just talked, what we kind of just talked about in the poll, right? And it's one contract. Let me put on my, okay. So the sell, you're actually selling one contract, okay, and it's a vertical spread. The 100 means 100 shares per contract, all right? It doesn't mean SPX 100 or 500. A lot of people get that confused, but it actually signifies that you're trading 100 shares of SPX with one contract, right? This is the expiration level, 11 October 21, right? And that's 6 days. Basically, this is 6 DTE. And we're trading 41.45, 41.35. So this is a 10 wide put, okay? And we're asking for 70 limit, okay? 70 cents. Now, when I looked at the market this morning, and that's what I would have put on, okay? Because I would have put it on at the open. Now, that particular position right now is worth 25 cents, okay? So that's how powerful it is, when you're putting on a trade in an ideal condition. So this morning it was an ideal condition. We would have already we already would have had 50% credit, and we could have closed this trade out already. Okay, and so that's basically how this works, right? Okay, so moving on here, the risk reward on this trade is $1,000 minus the $70 credit that you received, all right? So the max loss is $1,000 minus the 70, so it's $930, which you can lose on this trade, right? And again, I'm going to constantly remind you of that, because management is key to being successful with this trade, all right? So let's talk about the decay in options, because this is very, very important. So from 68 to 33 days, the rate of decay is 34%, right? From 33 to 5 days, the rate of decay is 57%, and from 5 days to expiration, it's 100%, right? We'll talk about the reason why I selected those strikes in a few minutes, okay? When we go to put on the trade, we'll talk a lot about that, all right? So now let's talk about the profitability factors, all right? Profitability factors, there's 3. One is implied volatility. Okay, so the ideal setup in the market is when volatility is moving lower while in a trade, and then placing the trade when volatility is high and then decreases will significantly reduce your premium collected. So I showed you a position, right? that we just talked about, where I would have put on that position at 70 because volatility was highest, and I'm going to show you a chart of that, all right, at that time. And right now, because of the market direction and because of where volatility going down, the premium shrunk very, very quickly, right? Okay, so that's what happened, right? So let's move on here. The second profitability factor is theta. It's the rate of decay. Okay, so this is one of the Greeks. It's the rate of decline and the value of the option due to the passage of time. It's a big factor for 70 TE and monthlies. And then the third one is market direction. So this morning, what do we have? We had market direction in our favor. We had volatility in our favor, right? And we had, decay, which happens in all options anyway, all right? So decay is constant, market direction and volatility are not, right? So in an ideal condition, again, you want to have volatility higher, you want to have the market direction in your favor, and you want to have, theta, right, which is the rate of decay in your favor as well. All right. Okay. So now let's look at. I'm going to have to change my chart here, or change my what you're looking at. Okay. Give me a second here. All right. Okay. So can you see that? Yes. Okay, great. All right. So again, this was the position that I had, that I was looking at this morning. So that's obviously not going to work right now. So now what I'm going to do, so this is the option chain, okay, and this is in Thinkorswim, right? You barely see it? Do you see it? Okay. Okay. All right. So I'll tell you what they are. I'll tell you the numbers, okay? Sorry about that. All right. Okay. So so now I'm looking at 11 October, 6 days to expiration. All right. So I'm not looking at. Oops. Let me go to the right place. So 8. I'm not going to go to 8 because I already have a position there, right? So that would violate my rules, right? So I'm going to, instead of using 8, I'm going to use 6, but I could use 10 because I'm not going to use an AM or an AM expiration, okay? I always use afternoon expirations on 70 TE. So I would skip that. But 6, the reason that I'm going to use 6, and typically I don't like to use expirations that end on Monday. And the reason for that is because we have 3 days, right, on Friday, and a lot of the decay happens on between Thursday and Friday because it prices in the weekend, right? And that's kind of what it does. But I believe because we're having a rally after a pretty nice move down, that we're going to lose. Volatility is going to decrease, and the market direction is probably going to continue going up now. Okay, so so now I'm going to go open the option chain. Okay, looking for the particular option that I want to get. Now, what's the delta that I'm looking for the short leg in this case? Anybody? You got it. 12. Perfect. Okay. So now you can see here the delta. Okay, it's combined with the spread, and actually this is something that I've noticed for years, and I actually put in a request in support this morning to see if you can actually, in a spread, you can actually see the individual strike prices in the delta. I can take my phone, right? I can take my phone, and I can actually, in my phone, I can actually look at the delta individually, all right? So and so to change this individually, I would have to go to, I'm going to go to vertical here. Okay. I'm going to change this to single, right? Okay. So now you can see the real delta here, all right? So now we want to get in between 4,200 and 4,205. That's where your 12 delta is on the short leg, all right? So that's where our short position, that's where I'm going to place my short position now. I'm looking at the market, it's going down a little bit, all right? So I'm gonna use 4,200 for the short leg, right? Okay, looking at it now. Okay, now I'm gonna go back to vertical. So I use a 10 wide. So I go here 1 month, 2 strikes, right? Vertical. Now it's gonna go back, right? So here, this is the position that I want to take. So I'm gonna click on that, all right? And oh no, it's not 2210. It's actually this one right here. This one. So it's 4,200, 4,190. Okay. So that's your 12 delta on here. So what I'm going to do is I'm going to put on 6 positions, 6 contracts, because that's what I normally do. Okay. Okay. So now this one's going a little bit higher. See here. All right. So now I'm going to place this position, right? So it's at 70. I'm going to lock it in. I'm going to lock in 70. Okay. 4,200 is 10 delta. Yeah, that's. Okay. Let me make sure here. And 10 delta is fine because we can use a 10 to 12 delta. Okay. All right. So I'm gonna place the trade. Okay. So you can see here now that the buying result, the buying power effect is $5,500 because it subtracts the position. All right, it subtracts the credit, right, that I'm getting, and I'm going to send it, but I have a feeling it's not going to fill. Right, so we're going to wait here a second. Right, so it's a working position now. It's 70. Okay. Right. So it didn't fill. And so what do you do when it doesn't fill? You cancel it. you can do a couple things. You can cancel it. Nope, it filled. Okay. So we should hear the sound here pretty quick. Okay, there it is. Right. And then I'm going to share with you. Okay, so that position filled. Okay, it's sold. You can see it here. Awesome. Oh, okay, you guys jumped in too. Great. Okay. So this is cool. This is a live session, right? Where I just put on a trade. All right. Okay, and you guys did too. And then I want to show you one more thing here. And this Okay, sorry about that. Okay, can you hear me now? Okay, perfect. Okay, great, great. Sorry about that. Okay, so you can see here now that the position showed up in the channel here, right? And this is how we do our trades. Okay, can you hear me now? Yeah. Max loss. Awesome. All right. Okay. So now I'm going to okay, I'm going to take my trades here. And I'm going to post this trade. And this trade should be 265, 266, I believe it is. Actually, we already got this one. This one actually filled this morning. We actually closed that trade this morning. Okay. So I'm going to put in 266 here. Okay. We put in the date. And this is trade 266. Put in the date. And we did 6 contracts. Format this guy. And we're good. Okay. All right. So so great. Filled, right? And you can see you know, other people are showing that they're filled as well. And I think some of you did it as well. Are there any questions for what I just went through? Any questions? Okay, perfect. And that's it. That's how we place a trade. That's how easy it is. All right. Okay. So let's go back here to the presentation. Okay. Perfect. All right. And hopefully now the market just did a little dip, and hopefully it's going to continue moving up. But if it doesn't, okay, I'm gonna show you something here now, because this is important. This is okay. I'm gonna show you my screen. Okay. So this is my main screen that I use, okay, for trading. Now I know it looks like a lot, but I'm gonna walk you through this real quick, okay? This area, this here is the SPX. So these two, this is I switched this from hourly to 1 minute. Okay, so when I'm trading 0 DTE, I like to see the SPX and 1 minute chart. Okay, but normally what I do here is I have fibs. Okay, on the hourly, and I have fibs on the daily. Okay, so this is the daily here, and this is the hourly, right? Okay, and so you can see here where support, and we're going to be talking about this. This is where support and resistance is, right? On these fibs. Let's see if I can make it. No, you can't make it smaller. Okay, but you can see here that where it stopped yesterday, and I didn't make this up. I had these fibs in. I've had these fibs in place for months, actually. Right? It dropped to this lower fib here, and it just stopped. The market just stopped going. It stayed there for a long time in the afternoon yesterday. Okay, and okay, I'm going to answer your questions in a second. Let me go through this. All right. So yesterday, the market stopped, and you can see where it broke this area here of that was before, you know, it broke here. And then it went up, and it went back down, and then it stopped here at the bottom. And so I expect it to go up to, eventually go up to the 4,400 level, probably this week sometime. and congest here, all right, and then continue moving up. It may or may not, but we'll see. Okay, we don't know. All right, but this is a pretty solid rally, even though we had one before and it went down again. But it'll always go down. Okay, so now where did I put my position? You know, at 4,200, right? So we're good as long as 4,200 is not breached, right? So it's actually 150 points away from the market for 6 days. And the reason for that is volatility, okay? This is volatility on a relative manner, okay? It's a daily, okay? This one right here, can you see it? Okay. And you can see that volatility went almost up to 30 on the 20th, right? And it kind of kept moving down, which is kind of bullish, you know, because you have that spike and then it moves down, right? So let me change the conditions here. So I'm going to make this an hourly on the VIX. And so this is a VIX, really important for you know, for placing trades, okay? And so this morning you can see here around 9 o'clock, it was around here, we had this nice dip down, right? And now we're having a little bit of a dip up, all right? And it's actually a good place to place a trade, because we caught that little dip that we had. And so so if you look at it now, I bet you that position is at, see, we got filled at 70. And again, what I do, right, it's still at 70. What I do now is I place a closing trade on this for 10 cents automatically, right? I just did it. So I place my closing trade at 10 cents. Yeah, and now you can see that the it's actually at 70 now. Yeah, it's varying, going between 70 and 75 cents, right? And so that way I have that position in front of me all the time, okay? And I can look at it. I know where it's at. I have it placed in the room. Okay, let me get the trade, and I'll place it in the room here. Okay, hold on a second. Okay, so this is the trade that I just made. Okay. That I just placed. Right? So the market has to go down. The market has to go down 150 points in 6 days before this position is truly threatened. Okay. Now, what are the probabilities that that's going to happen? I mean, okay, hold on a second. Okay, so here's the chart here. Let me blow it up so you can see it, because this is really, it's important for you to get a perspective on this. Okay, here's the daily chart. So now the market, okay, the market needs to go down. Hold on a second. That trend line. Got it. Got it. Got it. Okay. So the market has to go from here down to here before it's breached in 6 days. You know what that is? 3.62%. I know you can't see it very well. Yeah, I can take a screenshot. What screenshot did you want, Murat? Oh, the chart is fuzzy. Yeah, I'm sorry about that. So I'm going to leave this line here, right? Okay, down to 4,200, right? That's how far the market has to go down before this position is it's breached. Okay. And it's a major. This is a major support line here, 42.30 or 42.31. We're going to talk about exit strategy in a minute. Okay. So so the likelihood, and this is why it's called a high probability trade, right? The likelihood of this position being breached is very, very small. Okay. However, it can happen. And so when do we manage a threatened trade in volatility? Now it's heightened volatility. You know, it would be right around the 52.50 level is where we start mitigating this trade. All right. And when you do it that early, you can almost always roll your position for credit. Almost always. Okay. If you wait a little longer, you can't do it. Okay. And so, and if we place a call trade, okay, so let's look at the call position, right? Let's say we wanted to put on an iron condor, and this is great. This is exactly what you guys should understand. All right. Now we're gonna go look at the same position. Here, let me make this. Let me share it in a different way here, so you can see it again. Okay, that should fill your screen. Perfect. Okay, now we're going to look at the call side on this. Okay, so let's go back. Here, let me do it on my phone because it's just a lot faster. I'm going to go SPX options. Call strikes. We're going to go to 6, and where we would put this one. Okay, so I'm going to select, remember the delta that we used for this? Which one is it? For the call side? What's the delta that we use for the call side, guys? 6 to 8. You got it. Okay. Okay. So now I'm looking at 44.70. This is a 6 delta. Okay. On the short leg, I'm looking at 44.70, 44.80. Right. So let's go back to the chart. All right. So now, we would go from here. Okay. And I said 44.70. Right. So it would be to here. And this one is 2.6%. So you get a whole 1% difference from the call side to the put side, right? All right. That's correct, Rob. They're the most dangerous ones, okay? Although, you know, we have pretty good volatility here and it's going to probably decline. So what I sometimes do is put on a half position at a 6 delta, you know, to give us a little more premium. But yeah, the worst things that happen on the call side, not so much on the put side. That's a fact. Any questions so far? Okay. So we did, you know, the market did go down a little bit after we put on that trade, but I'm not worried about it at all. So, okay. so let's go back to what I look at here. So here are, these are MES. This is the futures. This is MES. This is MNQ. And I do trade those, and I'm in trades right now on those. And I use the hourly, the 5 minute, and the 1 minute, okay, on these. And I use MNQ, and I'm now testing NDX trades, to put on. I actually have one on now, an NDX trade that I put on a few days ago, and I'll be trading those pretty often as well once I get the strategy nailed down, right? Okay, so so any questions about what we learned, what we talked about here, placing the trade, anything that has to do with that? Okay. I'm not sure if I put on the call side. I just think that we may get a rip because this market has been down quite a bit, and we're moving out of that seasonal period of yes, fundamental factors. You got it, Charles. We're moving out of that period of seasonally bearish period, okay, and moving into actually a very good period. And so, to be honest with you, I probably will not place a call side on this trade. However, it is pretty low risk, but I've been slammed with low risk as well. So I'd rather just keep this in place, and we'll probably close out this trade depending on the market, right? Either Thursday or Friday. We'll probably close this trade, right? All right. In addition to the NDX and the regular SPX, I have the DX, the Dixie up here, which is the this is the dollar, okay, and this is the 10-year note, which is TNX, and I keep that in front of me all the time, and you can see it moved up, and so that mostly affects the NASDAQ, but I think the NASDAQ, because it went down about 7.5%, it's in rally mode, pretty much in rally mode now. And then the VIX, and then I use the futures VIX because this one is more closer to implied volatility, okay, than the others. And you can see here on this chart here, this I keep implied volatility on the SPX as well, because I use it a lot for 0 DTE and knowing where volatility is going. Okay. All right. All right. So let me see if there's any questions up here that I need to answer. Okay. If I missed it, go ahead and repost it, and I'll answer your questions. Okay. But I think I covered as much as I wanted to cover on adding a trade. We're going to put one on today, and we're going to put one on Thursday. Okay. We're going to put on 2 trades during these sessions. Any day is actually okay. You don't need to put them on just those specific days. Again, the criteria is really an environment where volatility is higher, and you place a trade assuming that it's going to be lower, right? And we're starting to come into that area now. In September, right? We were actually, I was over 2,000 on 7 DTE trades. I was over 2,000 on my 7 DTE trades. Placing 6 contracts, right? But I had to roll. I had to adjust those trades quite a bit during that period of time, and so even adjusting, I was able to keep those positions profitable, right? And that's